You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Good thing this is commercial talk radio as opposed to public talk radio, because you get too riled up before a show for public radio. You have to be mellower, Tom.
Wind it down. Now, that comes from the guy who has no career in public, where I do. You've never been on the public airwaves.
No, I have never been on the public airwaves.
Not once, but twice, by the way.
Yeah,
twice.
but that was public television.
No, I was on public radio, too.
You were on NPR?
Career started at KASB Bellevue, 1974.
Oh, that was before it got really quiet. That was before it took it down a notch.
What's that supposed to mean? Huh?
Wait a minute. Was there actually public radio in the 70s?
Well, it was a public
It was community radio.
Yeah. Not community. It was owned by the Bellevue School District.
Educational.
Yeah. I don't know how educational.
Wait. Excuse me. It was
public.
High school. It was high school.
Yes, it was.
Radio.
That's right. That was, by the way, I checked the other day. That was the peak of my career. That was the tip top.
Yeah, that was where
down from there. Sadly, yeah.
Really, seriously, consider Como to be a step down from your high school radio station.
Me. I'm talking about me here, not the station.
All right, because if I was the management
not
and staff of KOMO Radio Seattle, I would be very unhappy with you right now.
Lucky they let me in the studio here. That's a whole different thing.
And it's a fight every Saturday to get him in.
Believe it.
Oh, you're back?
Yeah.
Please, really?
Well, they did lock the doors for a few months, and now I'm back in.
So. Now they're letting you back in.
Good to know.
Hello, everyone. Welcome to Talking Real Money. I'm Don McDonald, the guy whose career is nearly over, Tom Cock.
Well, that's true of you, too, by the way.
Why are we doing this, then? It's just, this is too sad and pathetic.
All right. We'll try and clean it up a little bit for today. What do you say?
All right. Here's the deal. This is a show about money, about you and your money. Now, you may disagree with us, but we're probably right. So give us a call at 855-935-TALK. There's a reason why I said that. You'll find out in a moment. 855-935-8255. We will try to answer any question. Any question has anything to do with money, and answer it in the best way humanly possible based on decades of knowledge. In fact, between us in the financial services industry,
hate to do it.
We probably have as much experience as more experience than the years either of us have been alive.
And let's start there, because last year, 2019, a great year for Facebook stock, a great year for Facebook posts, if you believe Don's wife, Debbie. I mean, it's prolific number of posts.
She's on Facebook all the time.
I know. But was it a good year for Facebook investors to get investing advice and learn how to get rich?
2019 was not, because I decided to make it one of my business New Year's resolutions to make us a bigger presence on Facebook. Since my wife and all of her friends seem to be there all the time, I thought, I don't like it that much personally, but I'm going to make Vestry and Talking Real Money, particularly, a bigger presence. So after the first of the year, I started pushing our podcasts a little more on Facebook.
Yeah.
And so I did that starting, it took a while. Facebook declined to promote us at first because for some reason, because I said gambling in the title, they thought we were pushing gambling, and I had to write them back and go, no, we're actually opposed to gambling. So I started January 2nd putting our
We know how careful they are about the things they let up on Facebook.
Exactly.
I'm
going, wait, really? You let the Russians on and you won't let us on?
There's a message
Come
there.
on.
And it's not a good one, by the way.
Anyway, I put it up there, and wow, I did not expect so many of you would comment. the headline for this one is, are you an investor or a gambler? And then it says stocks, more like in gambling than investing. That's the headline.
Individual stocks.
I didn't have room for that.
Yeah, because we believe in owning stock markets, but not owning individual equities. And then what happened?
The first comment I got was from some guy, I don't know where he is. I'll read it to you. Poppycock. Poppycock.
Wrote that?
I have not used the word poppycock in my entire life.
Really? I was thinking I had to go back to the 70s for that. Okay.
I thought like the 1870s.
May have been.
Poppycock. I've invested in stocks for 30 years. Conservative stock picking paid for 2 children's college. See, poppycock. It works in a 19th century British accent.
It does, yeah. Very well, very well.
Yeah, so I got that one.
Yeah, what else?
Then that was immediately followed by some guy in Illinois who just went. Now, remember, this is a podcast. His response was, article is BS, except he spelled the word out.
Which we don't
like
want to say.
Like the whole world. Which, no, we can't say on the radio.
So we'll come back and talk about individual stocks.
I responded by, actually, it's a podcast, not an article. But, who wants to
Fine
quibble?
point, but yeah.
So we're going to talk about it. We're going to talk about why we believe
us.
individual stocks are gambling. And you can call us to argue with us, 855-935-TALK.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
855-935-TALK. Give us a call. We'll talk about money matters of any kind because, money does, in fact, matter a lot. And bear in mind, we're now Facebooking there. The Talking Real Money Facebook page is there. You can join the heated conversation. Call us names if you want. 855-935-TALK.
We've heard them all before, so go ahead.
We've heard them all before. 855-935-8255. And we're going to go over to the phones now. Don, you're on. Welcome to Talking Real Money.
Hello, Don.
Hi. So real quick, I don't want to take a whole lot of your time. My father's retired, and he's getting a Social Security check every month, and he claims that he doesn't pay any income tax, and I'm getting ready to retire. And I'm just wondering, has that changed? Do I have to pay income tax on my Social Security benefit?
It depends.
That's the right answer.
I'm imagining your father has no other source of income, correct?
That's correct. He's a gambler.
Yeah.
He's a gambler. Okay.
Yeah.
Professional?
Does he have any tips for us or anything? Or
Wait.
Looking
Does he report? Does he report his income?
When he wins, he has to.
Yeah. All right.
He says sometimes it's the chicken, sometimes it's the feathers.
Oh, that's one I hadn't heard either. I'm going to go with a chicken every time for my house. But
that's funny.
Well, he doesn't always win, so sometimes he loses.
I like that.
And then he has to wait
that's
for
why
his
they call it
Social Security
gambling.
check to come before he can. That's right.
And
yeah.
what is his
gamble.
game of choice?
He plays cards. I think he plays poker.
Okay.
Yeah, he's good at the bluff.
Well, he's in a situation where he would not. There are income limits that can cause Social Security income to be taxable at a certain level, but he apparently is under those numbers. So
in your case, you may not be. So it depends. A lot of people retire, take Social Security or don't retire, take Social Security. They don't realize they're paying a big tax on it. So that makes no sense.
Yeah, I'm waiting to my my FRA,
Good.
and then they say that you don't have to worry about how much you work, and so
no,
that's not true either.
But it's true to a point because before FRA, before your full retirement age, if you make if you make additional revenue above, I don't know, it's like 17,000 or 18,000
low number,
then your benefit actually gets reduced.
Yep.
But after FRA, then your your Social Security benefit, a portion of it can be taxable, but it is not directly reduced.
Yeah. Those are things to carefully consider before you retire. Your father's in a better spot.
Yeah, run some tax scenarios before you get there. And you can there are calculators online that can help you figure that out. Or if you have an investment advisor, they should be able to help you figure it out.
I do. I have an annuity, and from what I understand, there's a couple of things that changed. One change last year was that you're now allowed to put in $7,000 as the max
in 2020. That's correct. Mm-hmm.
Yeah, and I did it last year too.
Then you're going to have a $500 excess. The max contribution to an IRA or Roth last year was $6,500. The max this year is $7,000.
He had me put in $7,000 late last year, and this year he says I guess it's the same. But there's another change that just recently occurred is that now instead of the maximum age is changed from 70 to 72.
Well, yeah,
so you
okay.
can work until you're 72.
Yeah, okay. So I want to go. We'll go to
now. Tom, 2019. The contribution limit was $6,000 in 19 with a $1,000 catch up.
I thought that was 20. I thought that was 2020.
No, that was
okay.
That
so
was
what did
2019.
they change it to?
Yeah.
They changed it in 2019. It went from 55 to 6, and then to 7, and that's staying the same in 2020.
Okay, so he was correct. But then in terms of what you're talking about is required minimum distributions. The government, with the Secure Act, will now allow you to start your required minimum distributions from IRAs, 401ks at age 72, where it used to be at age 70 and a half.
Yeah. And I don't believe in 401ks. I know people that have lost because the companies went to hell.
But that has nothing to do with your 401k, sir.
Okay.
Yeah, I don't have a 401k.
Okay,
I never believed in it.
But I want to dispel
what I have is that. Okay, that's it doesn't apply.
The
to me.
health of the firm in which you work has nothing to do with the investments in the 401k, unless you hold company stock. Then it could.
Right.
But otherwise, they're separate things.
Which goes back to our original point that we were talking about. Owning individual stocks is a mistake. And yes, people have owned individual stock in their 401ks at work, and then the company went belly up. This happened at Washington Mutual.
And
this happened a lot at Enron.
WorldCom.
There were people owned a lot of company stock in their 401ks, and if the company goes to zero, in that case, then your 401k goes to zero. But to Tom's point, this is an important distinction. Whatever it is you have in your 401k is separate from the financials of your company. Those are in custodian accounts.
Yep.
They are not connected to your firm. If you had a 401k and it was invested with Vanguard or Fidelity or whomever, that money, even if your company went bankrupt, that money is still there and it is still yours.
Thanks for the
Just
call,
want to
Don.
clean that little fact up.
Good luck to your dad.
Yeah.
Do you split the tens? I always forget. Anyway, I should went to ask him, but I ran out of time.
You know what?
Nope.
It's gambling. And again, that goes back to our original point.
Yes.
Gambling is not an investment strategy. Gambling is not even, for most people, a source of income.
But let's finish with the individual stocks. The only reason you'd ever own an individual stock is to make more than the stock market, correct?
Right.
Why else would you do it?
Why else would you do it? Because the risks are dramatically higher.
And what it suggests is that you or the person telling you know something more about that company than others do. And you don't.
Which to me is just astonishing.
Sorry.
One, here's one of the the fact of the matter is, all of you who say, "Oh, buying individual stocks makes great sense. I've been successful." Congratulations on being lucky. Congratulations on being lucky. You were lucky. The vast majority of stocks do well, so your luck is enhanced by that. The vast majority of stocks go up while many go down. The fact of the matter is, though, you cannot know that the stock you own will not go to zero. You cannot know that. It is an impossible thing to know. Just ask anyone who owned Enron, General Motors, Delta Airlines, WorldCom, Washington Mutual, and the list goes on.
And here's the other thing to remember. The return you make on that individual stock needs to be far greater than holding a mutual fund of hundreds of companies because the risk is far greater. Way
You
higher.
do not. If you own a globally diversified portfolio of stocks, you have essentially zero risk of total loss of principal. If you own an individual stock, you absolutely have that risk. 855-935-TALK is our phone number.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Trying to help you move forward in life, have the money you need to enjoy a great future, and do it without all the garbage and gizmos and gadgets and confusion and frustration and complexity that the bulk of this industry throw your way. 855-935-TALK is our number. You can call during the show, or you can call 24 hours a day, 7 days a week. We'll take your calls on the podcast, and we'd love to help, really. Even if you disagree, we want to hear from you. 855-935-TALK. And Craig, you're next. Welcome to Talking Real Money.
Hello, Craig.
Hi, how are you doing?
We're doing great. How can we help you today?
Well, I'm nearing retirement, and I'm talking to a retirement planner or whatever, and he wants me to invest in a couple things. One is it's not a long-term care policy. He says it's through an insurance company.
Yes.
And so it's really an insurance vehicle, and they'll insure anybody, regardless of their health.
Okay. Yeah. It's these new hybrid
problems or
long-term
whatever.
care annuities.
Are you putting a certain amount of money into this, and then the premium gets paid out of that?
Yeah, I think it'll be $100,000.
Okay.
That's
Yep.
That's
very
that
typical.
long-term care.
And he said that it'll be good for $300,000.
Right.
That
Right.
I'd be
And
able
that's-
to withdraw over time or whatever.
Yeah, that's the insurance
or that
company
would be my
playing the
death
odds.
benefit.
Yeah, that's the insurance company playing the odds. They know but the problem is once you go past $300,000, it's all on you.
Right.
Yeah, we get
That's
that.
correct.
And yeah, these are pretty standard these days. We have mixed emotions about them, but what else is he pitching you? What else is he suggesting you
Well,
get
the
into?
other thing is, he wants me to become more conservative in my investing, which is fine. But he wants me to. It's trying to think. It's called the.
Can I
Alliance
wait? Can I?
Life Pro
Yeah. Okay. It's an
sorry?
indexed annuity.
Yes, it's an indexed annuity where it says you'll never lose anything, but it only grows.
Oh.
It only grows.
He's pitching
Can
that.
I ask you a question, Craig? What did they? How
Absolutely.
much did they imply it might grow? Imply. They didn't promise, but what did they imply? The returns of the stock
it'd
market,
be-
maybe?
Yeah, close or a little less than that, I think. But
Yeah.
Okay, but I'm
I
going to
know.
go back. I'm going to go back to the beginning. These are all good questions. So,
A great question.
the first part is for us as both advisors and practitioners and journalists. We truly believe that anybody listening, anybody should only go to a fee-only 100% fiduciary for this kind of advice for the exact reason you just mentioned, because the products that they're using, and by the way, there may be a reason to have long-term care. That's a separate issue, but those products have a commission involved. The commission creates a conflict of interest in my mind. And
Oh, it does. Even the FINRA and the Department of Labor believe that commissions create a conflict of interest. The SEC does.
number two,
It's not just us.
Yeah, number two, do you really need, and I'm going to say probably not, the equity index annuity? In other words, people have strange reasons for buying this because they buy them for what Don just said. I'm going to get basically the returns of the market with no risk. That has not been the track record. We can clearly show you, in fact, the numbers there. We looked at the one study that we could actually find right down where it was like 3% a year.
3.5%. Yeah.
That is not the return of the market,
Craig,
by the way.
And Craig, let me just throw a quick important question in. How old are you?
63.
Okay. And this money is the money that you would put into the indexed annuity would be for retirement, correct?
Correct.
Did they mention the surrender charge to you?
No, he didn't.
Oh, what an interesting thing to leave out. Do you know if you want to,
Yep.
let's just say something happened and next year you want to take all that money out? They're going to charge you 10%, 8 to 10% to
In
get
the
out.
worst case, yes, 10%.
And that lasts for somewhere between 7 and 10. I've even seen one that lasted 15 years where there was a surrender charge. They make huge commissions. They have massive incentive to sell you these policies. And the reality is they are so complicated. They are so convoluted. They are not simple. They make a fortune for the insurance agent, and they never make the kind of money implied for the clients. I wouldn't touch an index annuity for retirement with a 1,000-foot pole. I would stay away, and I would
Tom
never
and
talk to this
Don
guy.
are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information, talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
Oh, I so wish the people who sold variable or indexed annuities, even variable annuities, I just wish they would all go away. I know they won't. Or they'd get regulated, or they'd be required to act as fiduciary.
What's the one, Universal, the one that's more popular? It was written about in the journal today.
Universal, Indexed Universal Life.
Yeah,
Indexed
right.
Universal Life, yeah. Yeah, that was in the Wall Street Journal today where they...
You don't believe us about this? Go read the journal piece. They have an own insurance person there saying, these are sold that you get most of the market return and never lose. Don't sell them that way. And that's what regulators are looking at. Don't
Regulators, actually, even insurance regulators who tend not to regulate much. They tend to like, hey, you're an insurance agent. Do whatever you want. Just make sure your company hires me when I'm done being a commissioner, okay?
Oh, stop it.
855-935-TALK is our number. 855-935-8255. Oh, cynical? Am I cynical? Yes.
Okay.
A little bit. 855-935-TALK. That's the number, and Mo is the next caller. Hi, Mo. Welcome to the show.
Oh, hey guys.
Hey,
I had a question
What's
for
up?
you. I've got a Roth IRA, so I'm kind of familiar with the whole Roth IRA thing. But my son just got a job, and he signed up for a Roth 401k,
yes, sir.
and I wasn't familiar with that, and I don't know if he's still eligible to get a Roth on top of that, or if that kind of squeezes him out.
No, he can do both.
No, he can do both, yeah. Which is a great, great thing. I mean, when you're young and you're not making a ton of money, you'll probably make more later on. It's a great time to put money away in a Roth because you don't need the tax deduction, and then whatever you put in Roth vehicles grows tax-free forever. And he is eligible for both, subject to income limits, but I would imagine he's not there yet.
Which phase out, I think this year starting at like 190,000. So you're making more than 190?
Okay. No, that'd be nice, but no.
All right.
Yeah.
No, I highly recommend. I think Don's exactly right, especially for a young person. If you can afford to just use the Roth 401k, which is the same, the only difference between that and a regular 401k comes out before your income, so it's pre-tax. A Roth is after your income, so you already paid tax on it. Then that, as Don said, is going to grow tax-free. The pre-tax,
for 30 years or more.
The pre-tax stuff is going to grow, and then you have to take it out and pay tax on it. So for a young person to do that plus a Roth IRA, I think is huge. And
okay,
and by the way, how old is your son?
He's 22.
I mean, my recommendation there would be 100% in stocks, and if he's going to do the Roth IRA, go to Vanguard and just own the Vanguard Total World Stock Index, where you get 8,800 securities for like 20 basis points or something. I mean, it's dirt cheap.
10.
I mean, it's
okay. Yeah, his company kind of limits him on the 401k. I think he's in a age adjusted type mutual fund that'll change as he gets older.
This is an
a lot of
discussion.
them do target date. A lot of them force target dates.
In fact, I talked to Paul Merriman today because Paul's the only person in the world who writes me on Saturday morning at 4:27 a.m. and says, "Are you up? Would you like to chat?" I wasn't up till
and you're usually up at 4:27 a.m.
4:45. But anyway, he on his website, depending on, they have a lot of 401ks where they've analyzed. But the point is, if you have no interest in this, he believes, and I think it's right, do the two-fund approach. So in your son's case, it would be the one fund is the target date, and then add in, if they have available, small or small value stock fund, because that gives you some more exposure to the parts of the market that have had greater returns over a long period of time. Then you complement that by having the Roth, as I say, at Vanguard. That's the way I'd go.
Okay. Sounds good. And so the Roth 401k, I hadn't heard that name before, but it's basically just a 401k.
It is.
Yep.
It's because it's a company-sponsored retirement plan. It's simply post-tax money. That's the only difference.
It is a relatively new
it's
iteration.
Last 10
of the
years, 12 years,
401k
something like that.
Yeah.
Relatively
It's relatively new. So a lot of people who are just used to the regular old 401ks are still not familiar with them, but they're perfectly legit. And I think for the younger you are, the more sense they make. And thanks for the call, Mo. We really appreciate it. We've got a couple lines open because some folks dropped off. The number is 855-935-TALK, 855-935-8255. This is your life we're talking about.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
That phone number, and it's a really good phone number because you can call it anytime. You can call during the show when it's live on Saturdays from noon to 2 Pacific or 3 to 5 Eastern.
Don't call Paul Merriman at that hour. Don't call me. Paul does that. You interrupt his
But you
time.
can call our number at that
okay.
hour.
Yeah, that's true. That's a good point.
855-935-TALK, 24/7.
Yeah.
We're always taking your calls.
Okay.
And answering your questions.
Love to.
So do that, and we're going to do that now with Catherine. Catherine, welcome to Talking Real Money.
Hello, Catherine.
Hi. I've got a question about college funds. I know in the past you said Utah's the best one to invest in, so what's going on with that? Is it still Utah?
You know, it is our favorite for the following reasons. And by the way, here's that money that you put in the Utah 529 plan can be used for higher education in any state.
Anywhere.
Anywhere.
Yes.
So
you
that's
don't have to go to the University of Utah.
Or Brigham Young,
Young.
et cetera, et cetera. Here's the reasons why we like it. Number one, the costs are very, very, very low. Number two, there are no commissions. Number three, they have an age-based plan, which I think for most people makes sense. So the money goes in, and depending on the age of the beneficiary, the person who's going to use that, it's managed to that. So say, for example, the beneficiary is 1 year old. I got a 1-year-old grandson. It's basically 100% in stocks because they're not going to use the money for 17 years. I also have an 11-year-old daughter. Hers now, I just noticed the other day, has about...
Hard to believe, isn't it?
Know,
he has an
modern
11-year-old daughter.
Sweet kid, doesn't know anything about this yet. So let's just leave it at that. But hers, I just looked the other day, has almost 30% now in bonds. So it's 70-30 at 11, which makes sense, right?
Well, she's old. She's old. She's halfway
ancient.
there.
So it's managed to that end. And here's the fourth reason we like them. The type of mutual funds they employ are low-cost index or index-style funds. That's and you want to add anything to that?
From,
Tom? That's
from Vanguard and Dimensional.
Correct.
So we really like it. Although I would like to add something for anyone who might be listening in the state of Illinois. Illinois' new 529 is terrific for Illinois residents. Illinois is a high-tax state. And if you're an Illinois resident, you get a tax deduction for your contribution.
Yeah.
And their plan is almost identical to Utah's.
Really? They finally did something right. Does that help, Catherine?
They did something right.
Yeah, it does. Thanks a lot.
By the way, what is the website? Don always knows the website. Is it?
It's my529.com.
My529.com or .org? I think it might be .org.
I think
My
it is.
529 is.
You're going to challenge me on that.
I've been wrong. I think on every one of these so far today. So
they have both. They own both
right,
domain names. 529.com.
By the way, you mentioned Illinois. Fascinating story. Fascinating story.
What, about Illinois?
Yeah. They just floated some bonds. Now, they are the worst rated, I didn't know this, the worst rated municipality in the country.
Their finances are in horrible shape.
But know, because the municipal bond market is so hot and needs issuers, you know what the rate, I think it was like a 20-year bond. You know what they're paying?
No.
2.8%. because the market is so strong. So many people want to buy municipal bonds. Had a huge year, both in terms of returns and money piling into them that they can float a rate. Oh, yeah, it should worry you.
I mean, people are kind of getting stupid.
Own them. We don't own them because the funds we own will not own the quality of like that. I mean, I'd probably still a double B or something. But anyway, the point is you can float that kind of stuff out there because muni bonds are so hot. It was a big write-up in the Journal a couple of days ago.
Yeah, and by the way, for those of you who are listening in Illinois,
we love you.
It's called the Bright Start in Illinois. Brightstart.com. Bright Start.
And it has similar plan now. Huh?
Vanguard, Dimensional. Wow. They have the age-based. Fees are low. And for Illinoisans, it's tax deductible.
And now if they could do something about the corruption, the cold winters,
really,
and the lousy sports teams, you'd be okay. I'm kidding. I love
winters.
Chicago, okay? I love Chicago.
Oh, no, not in the winter.
No, I've never been there.
I lived there.
I know you did.
I worked at Sears in the tower. I have never felt cold like that. Cold that pierces to the bones. I had to carry literally in my pocket every day during the winter both a cigarette lighter and a lock de-icer thing, because sometimes you needed both. You'd had to like ignite your car to get the car door lock to open, because the water from the lake, the moisture would get inside your car lock, freeze it solid.
And people live there because
somebody built a town there.
I know why. Because the Cubs might win the World Series once every 100 years.
Because some idiot built a town there because it was right by a big lake.
Yeah, it is pretty.
For shipping cattle. No, it's not.
Because of the skiing? No, that's right. They don't have skiing because they don't have any mountains.
They don't have any mountains.
Yeah.
No, I'm telling you, it was because they could bring the cattle from the west, put them on a boat at
Lou
Lake
Malnati's Pizza. That's why. I love that pizza. Yeah.
Good pizza. All right. Pizza. I'll give you that.
Deep dish pizza.
It's not even the Sears Tower anymore.
Now what is it? I forget. They still take you by on the architecture
Willis Tower,
which I highly recommend if you go to Chicago. I've done that like 3 times. I love it every time. They go down the river
in the summer.
I just said I never go there in the winter. Who do I look like? I think I was.
And you know they had to make the Chicago River flow the other way.
I know that story. Yeah.
It used to flow into Lake Michigan, but it was so filthy. They had to make it flow the other way. I don't know where they dump it, but
that's because they had all the slaughterhouses there, right? And they just threw everything.
Oh yeah, that was pretty. That was the slaughterhouse capital of.
By the way, so when we come back, let's talk about what you, the listeners, believe is the best investment for the 2020s.
You mean in the next hour?
Oh, the next hour. Well, let's do it now. I thought we were coming up on a break. We got
no,
time?
I thought if you had something.
No, this is fascinating.
All right, what is it? What's the best investment for the 2020s?
Interviewed 1,000 of us and asked us, what do you think would be the best place to put your money for the 2020s for the best possible return?
Now, you remember the 2016 election and how good the polls were then.
Yeah. Right? Okay, well, this may have been. Okay, but here's the thing. Two-thirds of us who responded believe the best investment is real estate.
Yeah.
Real estate. So
Willis Tower.
Our friend Mark Hulbert, who I actually trust because he used to do the Hulbert Financial Digest where he looked at all the newsletters and said what a bunch of hooey all that was.
Plus, we know Mark, and we've interviewed Mark, and Mark we know is a straight-up guy.
Yeah, but he cites a study going from 1890 through 2018. You know the real rate of return for residential real estate? The real. This is
now, is that the
inflation.
shilling? Is that the shilling thing?
That's right.
Yeah. I knew this. It was less than 1%.
0.4%. Does that sound like you're getting rich? If you bought Treasury bonds, 2.7%. This is after inflation. And if you bought a not globally probably, but a diversified stock portfolio, 6.5%. But people believe in real estate. By the way, when I told this to one of our advisors, Brian, who's here today, he said, well, yeah, that's true, but not in Seattle. Everybody I love that. Everybody there. Well, that's not here because everybody gets rich here.
And people in the late 2000s were saying, yeah, that's everywhere but Phoenix.
Yeah, exactly. Yeah, until
that's everywhere but Denver.
Yeah, or
that's
San
everywhere
Francisco,
but New York City or San
Angeles.
Francisco. Or
Is. Now I get the coasts have made more than the middle. Okay, that's true.
Yes,
over time. There's no doubt about that. But
over time. But the reality is, real estate has been an investment that does one thing and does it well. It keeps up with inflation.
Yeah, that's basically what it's done.
That's all it's
And
done.
you should not buy real estate to get as an investment. It should be for lifestyle reasons. That's it.
Right. Now, there is investable real
Oh,
estate
yeah.
that generates income and the like, but the best way to get that is through a real estate investment trust.
Yeah, go to Vanguard, get a great one. Yep.
Your personal experience is not evidence. Your experience is an anecdote. You want evidence, and the evidence is real estate doesn't make a lot of money.
Tom and Don are talking real money.
Tom and I believe in helping everybody become a better investor. That's why we offer lots of free knowledge at talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And as you're probably aware, or at least we want to make you aware, our biggest event of the year's coming up. It's called Retire Meet. It is really the retirement event of the season of the year, and it's coming up in February. This is our 6th annual. Everyone's been a sellout, and right now, just for this weekend, this is the lowest price you're ever going to get for tickets to Retire Meet. If you use the promo code FLASH when you go to retiremeet.com, you'll get 50% off. Just go to retiremeet.com, promo code FLASH.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.